Hey guys, welcome back to Stock Tricks with Nick. This week had all the big tech companies reporting their Q1 earnings, the stock market dropping 3.6% from Wednesday's close, and Bitcoin popping up 18%. But all of that was pushed aside when Elon Musk started dropping Twitter bomb after Twitter bomb. With the NBA suspended, there's been a lack of Woj bombs, but Elon Musk was happy to fill the gap, tweeting on Friday, during trading hours, that Tesla stock was overvalued. Today we'll go over why Elon might have tweeted this, the impact it had on the stock price, and some consequences going forward. We'll also be covering Apple's and Amazon's earning, along with a couple stocks that I'm looking to trade next week. So let's get right to it. For a long time now, Elon's been against the forced stay-at-home orders. He's pointed out the fact that having businesses being forced closed will have an impact on a larger proportion of the population's health going forward. This continued on Sunday when Elon posted an article pointing out the moral hazard that some hospitals face when they're getting funding from the CARES Act. Giving additional funding to hospitals and states with a higher proportion of COVID-19 patients creates an incentive for hospital administration to mark more patients as probable to having the disease. Now, the total number of people with COVID-19 will be largely unreported with a lack of testing, but the proportion of patients between states may differ because some states only list patients that have tested positive, while New York lists their numbers on a presumed basis. Things heated up on Tuesday after the market closed when Tesla, the company that Elon Musk serves as CEO for, reported their Q1 earnings. During this call, he aggressively attacked the fascist stay-at-home orders, but that didn't seem to bother investors at all. The next day, Tesla stock opened 6.8% higher because they were able to remain profitable during Q1. On Wednesday, instead of shying away from his statement, he doubled down with a flurry of tweets. The first was an article looking at inconclusive data whether the shutdowns actually saved lives, with the caption, "Give people back their freedom." One congratulating Texas on opening up restaurants and retail stores this coming Friday. Another one on how all the predictive models on hospital bed occupancy have been wildly overstated. And finally, an article breaking down 5 facts that have become more conclusive with the larger data set that we have. And with this, Elon was getting blasted on social media. Many compared Elon's take with the stay-at-home orders to Mark Zuckerberg, the CEO of Facebook, saying that Zuckerberg clearly cares more for the health of the people, while Elon was just being money hungry. I think that's a fine hypothesis to have, but you have to look at each person's bias to understand their actions. Facebook is making more money than ever in ad revenue, as the traffic to their sites Facebook and Instagram have hit record highs. So he's making more money with the stay-at-home orders. Why would he want it to stop? Elon, on the other hand, has his own moral hazards. In his contract, Elon will earn a $350 million bonus as long as the market cap for Tesla stays above $100 billion on a 6-month average. This works out to be about $543 a share. Using a 130 period simple moving average, a rough estimate of the 6-month market cap average, Tesla's sitting at $534.34 a share. So chances were, unless Tesla shares crash below $500 immediately, Elon was going to get that bonus regardless of whether the stay-at-home orders were lifted. That's when on Friday, during trading hours, Elon decided to put his money where his mouth was. To prove that his opinion on the stay-at-home orders weren't tied to any monetary incentives, he decided to tank his own stock by tweeting out that the price was overvalued. Immediately, the stock dropped 10% and Tesla lost $15 billion of market cap. But the tweeting didn't stop there. He once again demanded that Americans get their freedom back, sang the Star-Spangled Banner, and confessed that his girlfriend was upset with him after he tweeted that he wanted to give away all of his worldly possessions. While all this was happening, the trading world was going berserk trying to figure out if Elon was hacked, trading under the influence, or just being Elon. CEOs will typically guide down their stock price in a more cautious manner, sometimes saying that last quarter's performance was abnormal, expecting lower demand in the quarter to follow, or saying that they're going to be seeing higher expenses. But never, other than Elon in the past, as the CEO came out and said specifically that their stock was overvalued. Of course, with his tweets and the stock price falling, investors were furious with him. Many are threatening to bring legal action against Elon and Tesla, which, if proven guilty, would be covered under a director and officer's insurance policy. This is not great news for Elon, because as of 2020, Tesla decided to non-renew their directors and officers insurance policy. They did this because many insurance companies try to charge extremely high rates because of Elon's past troubles with social media. On August 7th of 2018, Elon tweeted, "I'm considering taking Tesla private at 420. Funding secured." Of course, with this, investors rushed to get Tesla shares before they went private, with the stock surging 12.7% that day. As a consequence from this tweet, Elon took a settlement with the SEC on fraud charges. Not only did Elon have to step down as chairman, but Tesla had to pay $40 million in penalties and appoint independent directors. So it's clear why insurance companies would be charging higher premiums for a past offender. But instead of paying these extra premiums, Elon said that he would self-insure the company by paying for any damages that would be otherwise covered by this policy. So with his recent tweets, not only is Elon at risk of losing his $350 million bonus, but but he may be on the hook to indemnify investors of lost value. As the day went on and the tweet stayed up, it became clear that Elon wasn't hacked, and the shares of Tesla stayed low at $701.32. This is a 10.3% blow to the company's stock price from the previous day's close. I'm not sure what the consequences will be this time, or why Elon tweeted this, but it's going to be an interesting story to follow in the weeks to come. Personally, I was able to profit on this move on Friday because I was short after the stock broke under the 8-day exponential moving average before the tweets came out. During the recent rally from $446 to $869, the stock had maintained a closing price above this 8-day exponential moving average. During 4 of the trading days last week, it actually came down to test the support of the moving average and bounced back up. This was a signal to me that once this support was clearly broken, there was going to be a drastic move down. Now, I had no idea that the move down was going to be caused by the CEO specifically telling the world to short the stock. But hey, I'll take it. I started shorting at $745 and covered half my position when the stock bounced off the 20-day simple moving average. During this time, I wasn't sure whether the tweets were real or if he was hacked, and I wanted to make sure I locked in profit. When things are uncertain, it's a time to lower your position size, not increase it. Outside of the Tesla news, we had Apple and Amazon reporting their Q1 earnings after the close on Thursday. Apple shares fell on Friday, mostly due to market pressure, as they reported flat revenue, pulled their Q2 guidance, and increased their dividend by 6.5% to 82 cents a share. Amazon shares fell 7.6% on Friday, as the CEO, Jeff Bezos, told investors to take a seat. He said that during a typical quarter, he'd expect $4 billion of profit in Q2. But instead of just taking this profit, he's going to be spending it all on COVID-19 precautions. With much of Q1 earnings season done, it's time to start trading with more technical analysis. So let's jump to the E-Trade platform to take a look at some stocks that I'm watching going into next week. First, we'll talk about Facebook, and I'm watching this as a possible short. After their earnings call on Wednesday this past week, the stock jumped up 8% to the daily high of $209.69. This is an important move, as this gap up covered a previous gap down on February 24th, when the stock fell from $210 to $203. With this gap being closed, the investors that bought at those prices were free to sell at break even. We saw the sell-off start as we got a red candle above the Bollinger Band on Thursday, which is typically a signal that the next day will pull back further. And that's exactly what the stock did, closing down 1.2% on Friday. I think there's more room to drop though, because just as we filled a previous gap, this earnings pop created a new one. Also below these prices is the converging 8-day exponential moving average, this pink one, and the 200-day simple moving average, the yellow one. And if we look at this recent rally, the stock has stayed above the 8-day exponential moving average except for once the entire time. If the stock moves lower, I would close a portion of my short at this convergence of $192. If the stock moved even lower than this, look at the gap here at $175 to close some positions, conveniently where the 50-day simple moving average is, this red one. As always, technical analysis doesn't work 100% of the time. You're just looking for a strategy to put the odds in your favor and bet with small portions of your portfolio so you can earn profits using the law of large numbers. Another stock to possibly take short is Nike. As the entire market's been moving higher, this has 2 gaps in the chart, once after their earnings and then once on April 3rd. The entire time after this initial move, the stock's been trading above the 20-day simple moving average, this green one. And we saw 3 days where the stock moved lower to test it and found support there. Then on Thursday, we got our first close below the 8-day exponential moving average, this pink line. And then on Friday, the first close below the 20-day simple moving average. Again, this green one. Also, the volume the last 3 trading days have been slightly increased as well, pointing that people are trying to get out of the stock. 2 areas that I would look to take profit from this trade would be the high before the second gap here at 79.36, and then again at the high of the first gap before earnings at 72.66. Now you have to have an exit strategy before you put on a trade. That way you don't trade it with emotions, but instead with a plan. So my exit strategy would be to get out if we broke over both the 20-day simple moving average and the 8-day exponential moving average while going over Thursday's high of $88 right here. Thanks for tuning in to Stock Tricks with Nick. If you want to get started investing, E-Trade will give you a promotional $100 when you deposit $5,000 with them. Link in the description. If you haven't yet opened up an IRA to shelter some of your gains from taxes, make sure you do so by July 15th so you can contribute to the 2019 accounting year. Comment below on any stocks that you want me to review and give my own personal, do your own research, not official opinions on. For more of my own personal opinions, in the description below are links to my Twitter and StockTwits accounts. Along with those is my trading journal, where I recap the trades I made each day. If you enjoyed this video, please like and subscribe to my channel, where I make weekly trading recaps like the one you just watched, and weekly personal finance videos. Stay safe, and I'll see you next time.